we see commodities all around us. Prices of commodities going up or down affects our day-to-day activities. To put things in perspective, anyone who drives a car would be impacted by the rising crude oil price, or weather prediction of under average rainfall affects our crop production and thereby the price of our next meal. Hence, commodity market is basically a place that facilitates trading of such various commodities. In India, MCX trading is the exchange for commodity trading. Commodities in the market are largely divided into three groups: metals, agriculture produce, and energy. The metals are further classified into non-precious metals like iron, steel, aluminium, copper, and precious metals such as gold, silver, platinum, and palladium. Agriculture produce are called soft commodities. As the name suggests, it includes coffee, cocoa, wheat, corn, and other things. Energy includes crude oil, natural gas, coal, and other such energy resources. The most direct and popular form of taking part in commodity trading is through the futures market. An indirect way you can take part in commodity trading by buying or selling stocks that are related to commodity in some ways. How can you trade in a futures market? Two types of investors participate in the futures market: commercial or institutional investors of commodities, speculators who hedge risk as well as hope to earn money. Commercial users of commodity take advantage of commodity trading for reducing their risk. Let us take an example. Aman runs a coffee shop. Currently, he is purchasing coffee at 2000 rupees per kg. He is speculating coffee prices to go up in the next year to rupees 2300. And now there's Ramesh. He owns a coffee plantation as well. His cost of production is 1800 rupees per kg. Currently, he is selling coffee at 1900 per kg. He fears that coffee prices may go down in the next year, and he does not want to sell it at a price lower than his cost. Here both the parties have a price risk. Aman fears that it will go up, while Ramesh fears that it will go down. To reduce the risk faced by both parties, they enter into a contract to sell coffee at 2100 rupees in the next year. Manufacturers and service providers use futures as a part of their budgeting process to normalize expenses and reduce cash flow related headaches. In case of speculators, they hope to earn a profit from the change in price of the futures contract. Speculators typically close out their positions before the contract is due and never take the actual delivery of the commodity itself. Commodities depend on many external factors such as irregularity of monsoon, domestic and international government policies, technological advancements, and many such more things. Hence, it is advised a person should only invest a limited portion in commodities trading when managing their entire portfolio. For investing in commodities, you need to understand the factors impacting a particular commodity's price. If you liked our video, give it a thumbs up and subscribe to our channel, and visit our website www.edelweiss.in.